The amateur investor seeks the grand slam. They want the one stock, the one trade, the one piece of insider information that will make them rich overnight. They are addicted to the narrative, the disruptive technology, the charismatic founder, the compelling growth story. This is the tyranny of the narrative, and it is a trap. It is the human desire for a simple, heroic solution to a complex statistical problem. In my early days, before the founding of Renaissance Technologies, I was still wrestling with the application of pure mathematics to the real world. I had spent years in code breaking in academia where problems had elegant, singular solutions. The market, however, seemed to defy this. It was too noisy, too random. The initial attempts to find a single powerful predictor, a massive, obvious inefficiency, were fruitless. It was like searching for a single perfect diamond in a mountain of sand. We were looking for a signal so strong that it would cut through the noise, a pattern that would guarantee a 90% success rate. This search was a waste of time, a concession to the human desire for certainty. The breakthrough came when we stopped looking for the diamond and started collecting the sand. We realized that the market is not defined by a few massive, predictable movements, but by an infinite number of tiny, fleeting inefficiencies. The traditional investor dismisses a 51% probability of success as insignificant. They want 80% or 90%. They want the comfort of a high conviction trade. But in the system where you can execute thousands of trades a day, a 51% edge is not insignificant. It is an absolute certainty of profit over time. This is the fundamental power of the law of large numbers applied to finance. Let us define what a 51% edge truly means. It means that for every 100 trades you execute, 51 will be profitable and 49 will be losing trades. If the average profit on the winning trades is equal to the average loss on the losing trades, you have a net profit of 2 units for every 100 trades. This is a small, almost imperceptible advantage. But now, scale that. Execute 10,000 trades. You will have 5,100 winners and 4,900 losers. That small 2-unit advantage has now compounded into 200 units of net profit. The key is not the size of the advantage, but the frequency and discipline of its application. Consider an analogy from the world of physics. Imagine a complex machine with thousands of gears, each moving slightly out of sync with the others. The traditional investor tries to predict the machine's overall movement by observing the largest, most visible gears. They might be right 60% of the time, but the effort and risk are enormous. The quantitative approach, however, is to measure the minute friction and misalignment in every single gear. We don't need to know where the machine is going. We only need to know that gear A is statistically likely to turn 0.01 degrees before gear B, 51.5% of the time. This is the essence of high-frequency trading, exploiting the microscopic transient deviations from market efficiency that are too small and too fast for human traders to notice or act upon. We built a system that could execute thousands of these small, low-risk, high-frequency trades. Each trade, individually, was almost meaningless. It might only yield a fraction of a percent. But the sheer volume, the relentless, unemotional application of a tiny, persistent statistical edge transformed the outcome. The market is not a lottery. It is a casino. The house doesn't win by hitting the jackpot. It wins because the odds are always mathematically in its favor, even if only by a fraction of a percent. The casino understands that in the long run, the small, consistent edge is an insurmountable force. Your goal is to become the house, not the gambler. The human mind is ill-equipped for this. It craves the dopamine hit of the big win. It suffers the pain of the small loss. It is psychologically difficult to execute a trade that you know has a 49% chance of failure. But the quantitative mind understands that the individual trade is irrelevant. Only the aggregate outcome matters. The loss is not a failure. It is a necessary data point in a statistically profitable system. Stop searching for the perfect trade. Start searching for the persistent, tiny, mathematical advantage that can be applied thousands of times. Success in this domain is the aggregation of marginal gains, not the pursuit of the spectacular. The moment you believe you have a grand, intuitive insight, you have already introduced the error of human arrogance into your system. The market is a vast, complex system, and the most reliable profits are found in the statistical dust, not the shining narrative. This requires a profound intellectual humility, the willingness to accept that your human intuition is a liability and that the only reliable guide is the cold, objective output of a well-tested model. Humans are wired for narrative. We see two events happen in sequence. A company announces a new product and the stock goes up, and we immediately construct a causal link. We say, the market reacted positively to the innovation. This is the illusion of causality, and it is the second fatal mistake of the beginner investor. The human need for a coherent story is so strong that we will invent one where none exists, or, more dangerously, we will cling to a simple, false story to explain a complex, true phenomenon. In the early days of our modeling, we made a conscious decision to treat the market as a black box. We did not care why a pattern existed, only that the data confirmed its existence with a statistically significant probability. If our model showed that the price of soybeans in Chicago had a correlation with the closing price of a specific European bank 2 days later, we would trade on that correlation, even if the causal link was utterly opaque or even absurd. The traditional analyst would demand an explanation. Is it a commodity hedge? Is there a shared supply chain? We simply asked, is the correlation statistically robust and persistent? If the answer was yes, we traded. This is a profound shift in mindset. The traditional investor needs a story to justify their action. They need to feel intelligent, to be able to explain their trade at a dinner party. The quant needs only one thing: predictive power. The story is a distraction, a comforting lie that masks the true complexity of the system. Let me give you a simplified example. Imagine we are analyzing the movement of a stock. A traditional analyst might look at the company's earnings report, the CEO's demeanor, and the geopolitical climate. They are looking for reasons. Our model, however, might discover a pattern. When the stock's volume on a Tuesday is 1.5 standard deviations above its 20-day average, and the price closes in the bottom quartile of its daily range, the stock has a 52% chance of rising by more than 0.5% on Thursday. There is no intuitive reason for this. It is a statistical artifact, a fingerprint left by the collective, non-rational behavior of millions of traders. The traditional mind would dismiss this as noise. The quantitative mind sees a profitable, exploitable pattern. The pattern exists because human beings, in aggregate, behave in predictable, non-rational ways. Perhaps this specific combination of volume and price movement triggers a cascade of automated stop-loss orders, which then creates a temporary oversold condition, which is then corrected by a different set of automated systems 2 days later. The why is a rabbit hole of complexity. The what, the measurable, exploitable pattern, is the only thing that matters. We learned to filter out the noise of human explanation. We found that the market is full of these statistical ghosts patterns that exist not because of fundamental economic principles, but because of the predictable, repetitive ways that human beings react to information, to fear, and to greed. These reactions create measurable, short-term deviations from efficiency. The market is not perfectly efficient, it is merely mostly efficient. Our job is to find the small, temporary pockets of inefficiency created by the friction of human interaction. The moment you start asking why a pattern works, you risk introducing your own biases and breaking the model. You might say, the model is telling me to buy, but the news is bad, so I will wait. In that moment, you have replaced a statistically validated signal with a subjective, emotional judgment based on a narrative. You have traded a mathematical edge for a hopeful guess. The market is too complex for any single human mind to fully comprehend the causal chain. The data is the only objective truth. Your job is not to understand the market. Your job is to listen to the data. This principle extends beyond trading. It is a principle of life. Do not confuse explanation with prediction. Many people can explain why something happened after the fact. Very few can predict what will happen next. The ability to construct a compelling narrative about a past event is a sign of intelligence, but it is not a sign of predictive power. The quantitative approach demands that you prioritize predictive power above all else, even if the mechanism of that prediction remains a mystery. The model is the oracle. Your job is to obey its pronouncements, not to interrogate its methods. Abandon the need for a compelling story. Causality is a human comfort. Correlation is a mathematical tool. If the data tells you to buy, you buy. If the data tells you to sell, you sell. The moment you override the system, because this time is different, you have replaced a proven mathematical edge with a hopeful human guess. The market does not care about your feelings or your explanations. It only responds to the flow of capital, which can be modeled but rarely explained in simple human terms. The third and most destructive mistake is the introduction of emotion. Fear and greed are not abstract concepts in finance. They are quantifiable forces that create the very inefficiencies we exploit. They are the psychological friction that allows a quantitative system to profit. Imagine a trader who has just experienced a significant loss. Their natural human reaction is to panic, to sell everything, or conversely, to double down in a desperate attempt to recoup the loss. This is the moment when the market is most efficient at separating the emotional from their capital. The human nervous system is designed for survival in the savannah, not for rational decision-making in a high-speed financial environment. When faced with a loss, the amygdala, the brain's fear center, takes over, overriding the prefrontal cortex, the seat of logic and planning. This is a biological failure, not a moral one. The human brain is a magnificent tool for solving complex, novel problems, but it is a terrible tool for repetitive, high-speed, high-stakes decision-making. It is too slow, too inconsistent, and too easily hijacked by the primitive survival instincts of fear and greed. When we began to automate our trading, it was not merely for speed, it was for purity of execution. The system was designed to be perfectly unemotional. It has no memory of the last loss, no hope for the next gain, and no ego to protect. It simply executes the mathematical instruction. It is a perfect, tireless servant of the logic we programmed into it. I recall an early period where a specific model was generating a series of small, frustrating losses. The human traders monitoring the system were becoming agitated. They argued that the model was clearly broken, that it needed to be shut down and recalibrated. The data, however, showed that the model was still operating within its statistically defined parameters of expected variance. The losses were painful, but they were expected losses. The model was simply traversing the negative side of its expected distribution. If we had listened to the human emotion, the fear, and the doubt, we would have shut down the model just before it entered a period of massive profitability that more than compensated for the earlier drawdown. The human mind sees a loss and feels pain. The algorithm sees a loss and registers a data point. The algorithm is patient because it is incapable of impatience. It does not feel the urge to get even or the temptation to take profits early. It simply follows the statistical mandate. This is why automation is not a luxury. It is a necessity. It is the only way to ensure that the mathematical edge you have discovered is executed with perfect, unwavering discipline. You must remove the human element from the decision loop. The moment a human is required to press the buy or sell button, the system is compromised. The human will hesitate, they will second guess, they will introduce the noise of their own psychological state into the pure signal of the model. Think of it as a complex mathematical proof. Once the proof is established, you do not question the arithmetic every time you use the result. You trust the process. A quantitative trading system is a proof in motion. The testing and validation are the proof. The execution is merely the arithmetic. To interfere with the execution is to question the proof itself. Your greatest enemy in the market is not the competition. It is your own nervous system. If you cannot automate the execution of your strategy, you have not truly committed to a quantitative approach. Design a system, test it rigorously, and then step away. Let the logic, not the lizard brain, do the work. The goal is to create a closed-loop system where the only human intervention is the initial design and the continuous, unemotional refinement of the models based on new data. The financial world is often insular, populated by people who have only ever studied finance. This creates a dangerous echo chamber where everyone is using the same tools, reading the same reports, and therefore seeing the same opportunities. If everyone is looking at the same thing, the edge is already gone. The market is a complex system, and to solve complex systems, you need the most powerful, diverse, intellectual tools available. My firm was built on the principle of cognitive diversity. We did not hire MBAs or Wall Street veterans. We hired mathematicians, physicists, astronomers, and computer scientists. We hired people who had never traded a stock in their lives. Why? Because they brought a completely different set of tools and a fundamentally different way of thinking to the problem. They were unburdened by the traditional, often flawed narratives of finance. A physicist, for example, understands complex systems, noise reduction, and the statistical analysis of massive data sets, skills that are far more relevant to modeling market behavior than traditional financial analysis. They see the market not as a collection of companies, but as a vast, noisy data stream that needs to be filtered and modeled. They are trained to look for invariant principles and to apply the rigorous methods of the scientific method: hypothesis, test, and rejection. I remember a conversation with one of our early recruits, a brilliant algebraic geometer, and he was struggling to understand the concept of a PE ratio, and I told him to forget it. I told him to treat the market data as if it were data from a particle accelerator, just numbers, without any inherent meaning, waiting to be modeled. His lack of financial knowledge was his greatest asset. He was not constrained by the traditional narratives of value, growth, or momentum. He was only constrained by the rigor of his mathematics. He was free to explore nonlinear relationships, to apply techniques from signal processing and speech recognition, and to build models that were utterly foreign to the financial industry. Consider the problem of noise. In physics, a significant portion of the work is dedicated to separating a faint signal from overwhelming background noise. The market is the ultimate noisy system. The traditional analyst sees the noise and tries to interpret it. The physicist sees the noise and tries to filter it out, or, more accurately, to find the faint, persistent signal within the noise. They are equipped with the mathematical machinery, Fourier analysis, wavelet transforms, and advanced statistical mechanics to do this effectively. This outsider perspective allowed us to see patterns that the finance-trained mind was blind to. They were not looking for the fundamental value of a company. They were looking for the statistical predictability of its price movement over a short time horizon. This is a subtle but profound difference. It shifts the focus from subjective judgment to objective, measurable data. Your intellectual environment is your most valuable asset. If you are surrounded by people who think exactly like you, you have no edge. Seek out the outsiders, the people who approach the problem from a completely different discipline. The most powerful insights often come from the cross-pollination of seemingly unrelated fields. The market is a mathematical problem disguised as a financial one. Treat it as such and staff your efforts with the best mathematical minds you can find. The market is not static. It is a constantly evolving, adaptive system. The moment you discover an inefficiency and begin to exploit it, you are, by your very action, contributing to its eventual disappearance. This is the concept of the half-life of an edge. The market is a vast, self-correcting mechanism, and every profitable strategy is a temporary deviation from equilibrium that the system will eventually absorb and neutralize. In the early days of quantitative trading, the inefficiencies were larger and lasted longer. The market was slower, the data was less accessible, and the competition was less sophisticated. As more capital flowed into the space, and as technology improved, the half-life of any given edge began to shrink dramatically. A pattern that was profitable for a year might now only be profitable for a month or even a week. The time between discovery and decay is constantly decreasing. This means that your work is never finished. The moment you become complacent, the moment you rely on a model that has been profitable for too long, you are setting yourself up for failure. You must be in a state of perpetual, aggressive research. You must treat your current profitability not as a permanent state, but as a temporary dividend from past innovation. Our research process is not about refining old models. It is about constantly searching for new uncorrelated signals. We assume that every model we have running is already decaying. We treat every successful strategy as a temporary phenomenon. This forces a culture of intellectual humility and relentless innovation. We are not trying to build a perpetual motion machine. We are trying to build a sequence of temporary, profitable machines, one after the other. Imagine a predator in an ecosystem. When the prey is abundant and slow, the predator thrives. But as the prey evolves to become faster and more elusive, the predator must also evolve or it starves. The market is the ecosystem, and your strategy is the predator. The moment the market learns to anticipate your move, your edge is gone. This requires a massive investment in infrastructure and talent. You need the computational power to test billions of hypotheses and the human talent to generate those hypotheses. It is a race against time, and the finish line is always moving. The cost of entry into this domain is not just intellectual, it is infrastructural. You need the ability to process and analyze petabytes of data, to execute trades in milliseconds, and to iterate on your models daily. Furthermore, the decay of an edge is often nonlinear. A model can be highly profitable one day and suddenly stop working the next, not because of a fundamental shift in the economy, but because a competitor has discovered the same pattern and is now exploiting it, or because the market has subtly adapted to the collective behavior of all quantitative systems. This is why diversification is key. You must run dozens, if not hundreds, of uncorrelated strategies simultaneously. If one strategy decays, the others continue to generate profit, buying you the time needed to develop the next generation of models. An edge is not a permanent asset. It is a temporary lease. You must budget for its decay. Never fall in love with a model, no matter how profitable it has been. The only constant is the need for new, uncorrelated sources of profit. The quantitative mindset is one of perpetual motion, driven by the certainty that today's success is tomorrow's history. We have covered the three fatal flaws and the two principles of continuous advantage. Stop chasing the grand slam. Aggregate thousands of tiny, persistent mathematical edges. Abandon the need for a story. Trust the data's predictive power, not your intuition's explanation. Automate your execution. Remove your nervous system from the decision loop to ensure perfect discipline. Seek cognitive diversity. The best solutions come from applying tools from unrelated fields. Assume your edge is decaying. Maintain a culture of relentless, aggressive research. The mindset of a quantitative investor is not about being smarter than everyone else. It is about being more rational, more disciplined, and more systematic. It is about replacing the chaos of human judgment with the unwavering logic of mathematics. This is not a path to quick riches. It is a framework for long-term sustainable wealth creation built on the only foundation that truly matters: probability. If this logical framework resonates with you, I ask you to do two things. First, Like this video to ensure this message reaches others who are ready to abandon the emotional fiction of traditional investing. Second, leave a comment below. Write one sentence about how you will apply the main lesson, the necessity of removing emotion to your own life, starting today. Let me leave you with one final thought, a concept from my academic past that applies perfectly to this world of finance, the concept of information theory. Every piece of data, every price movement, every news headline is a form of communication. The market is constantly transmitting a signal, but it is buried in an overwhelming amount of noise. The traditional investor tries to decipher the signal by listening to the loudest voices, the most compelling narratives. The quantitative investor, however, applies the rigorous mathematics of information theory. We are not interested in the meaning of the message, but in its entropy, its predictability. We seek to measure the information content of every variable to determine which data points genuinely reduce uncertainty and which are merely random fluctuations. This is the ultimate discipline, to treat the market as a channel of communication and to use the tools of pure mathematics to extract the signal from the noise with perfect, unemotional precision. This is the final layer of the quantitative mindset, the one that ensures the long-term survival and success of the system.